Hey Insurance, this is Tony Cañas, Chief Motivational Officer at Insurance Nerds and PNC Client Advisor at the Jacobson Group. Today I want to talk to you about the industry's transition to production underwriters and how it could misfire. As I make this video, the labor market for underwriters in the US PNC insurance space is scorching hot and showing no signs of cooling down. I've seen so many underwriters make moves recently and get big raises that it really is kind of crazy just how hot it is. Traditionally, insurance was underwritten by desk underwriters, whose primary responsibility was underwriting profitable business, and they were primarily measured by keeping a profitable loss ratio. They were not responsible for the growth or flow of incoming business. The best desk underwriters became technical experts in underwriting, whatever lines of business and whatever types of business they specialized on. They were supported by sales managers who were in charge of the relationship with the brokers who sold the business and for growth and inbound flow of business. Okay, so underwriters, the desk underwriters, responsible for loss ratio and profitability, and on the other hand, sales managers responsible for growth and flow of business, responsible for the relationship with the brokers. This created a very healthy separation where underwriters focused on optimizing for profitability and sales managers focused on managing relationships to optimize for growth. There's a couple of problems with this setup. Number one, sales managers are rather expensive with company cars and big bonus potential. And number two, while brokers love sales managers to get a contract to a new market, to get trained on systems and appetite, to get their staffs trained on systems and appetite, and to get taken out to lunch, golfing, or to watch a ball game, once that relationship is well established, the person that the brokers really want to see and build a relationship with is the underwriter, because the underwriter is the only one that holds the pen, has underwriting authority. So what good is the sales manager's promise to write a tricky piece of business if the underwriter has the final say and ends up saying no? No good at all. So to fix those two issues, many carriers are working on a transition to a production underwriting model. So what is a production underwriter? Production underwriters have responsibility for both maintaining a profitable loss ratio and for maintaining great relationships with the brokers and increasing growth and the inbound flow of business. Field underwriters also tend to fall in the same model of dual responsibility. They're also responsible for growth and underwriting. This fixes both of the issues that I identified earlier. It lowers costs by eliminating the expense of a sales manager or the expensive sales managers, and the brokers have a more direct connection with the underwriter who holds the pen and who makes the decisions on whether to write a piece of business or not. However, I believe that we will have two new problems when it comes to production underwriters. Number one, a traditional underwriter only needs to be good at the analytical piece of underwriting, not particularly good in the relationship piece of underwriting. Finding people who are good at both and who enjoy doing both will be a lot harder. In terms of the disc profile, desk underwriters can be high Cs. And high Cs are generally not high Is, or almost by definition. In this profile terms, by definition, high Cs are never high Is. And what you want is that relationship owner to be a high I, right? So basically, it's very hard to find somebody, if not impossible, who is both really good at the analytical piece of underwriting, the underwriting piece, and also at the sales manager piece of production underwriting, which is the high I piece. The second, and I believe biggest problem, is what I am going to christen the Lamparelli underwriting conundrum. I'm naming this after my very good friend Nick Lamparelli, who first clued me in to this potential problem a few years back. In a hot labor market that quickly rewards you for success and doesn't penalize you for changing companies, a smart and ambitious young underwriter has a strong incentive to optimize for growth over long-term profitability, which can easily lead to the underwriting growing a book quickly for 2 to 3 years, using that success, looking like a rock star, to make a move to another company with a big raise, and they'll be long gone by the time the book they left behind blows up. All they have to do is write lots of risks that are profitable in the short term without worrying about long-term losses. This video is simply meant to jumpstart the conversation on how we should measure underwriters in order to properly incentivize long-term profitability. I really don't have any answers on this one. I simply want to point a light to the problem, to a potential problem that I believe will affect many carriers in the future. Thanks for watching. I hope this was helpful. Ultimately, the biggest thing that we need to start thinking about is the reality that you can't serve two masters. A production underwriter can't optimize for both loss ratio and profitability. So we need to find ways to incentivize them, measure them, and manage them in such a way that the incentives are properly set up for them to not only grow the book of business, but also to underwrite the book for long-term profitability, even if they are no longer in charge of the book 5 or 10 years from now. Thank you.